This is Nightly Business Report with Bill Griffith and Sue Herrera.
Boeing warns the aerospace company says it could suspend production of its 737 MAX, and it posts its largest ever quarterly loss. Digging a hole, Caterpillar is considered a barometer of the global economy, and right now it's feeling the pain of the slowdown. Friending Facebook. Revenues are up and users are not going anywhere as the company tries to push past all of the regulatory pressures. Those stories and much more tonight on Nightly Business Report for Wednesday, July the 24th. And we do bid you a good evening, everybody, and welcome. Sue is off tonight. The S&P and the NASDAQ both closed at record highs today, but the Dow was dragged lower in part because of Boeing, which reported a massive loss for the second quarter. It also warned about something that no shareholder wants to hear about, that it may have to halt production of its 737 MAX if the grounding of the jetliner drags on much longer. That pushed the stock 3% lower in today's trade. Phil LeBeau is on the story for us tonight.
With the 737 MAX grounded for months, Boeing CEO Dennis Muilenburg says his company could shut down the MAX assembly line if the current plan for recertifying the plane this fall is pushed back even further.
If any of the timeline assumptions change significantly from a start of the fourth quarter return to service, then we'll have to evaluate alternatives. And those alternatives could include different production rates. They could include a temporary shutdown of the line. Not something we want to do, but an alternative that we have to prepare for.
Stopping production could mean temporarily laying off thousands of workers and have a ripple effect on suppliers around the country. It all comes down to when the FAA and other regulators say the MAX is safe to take off. A software fix for the plane is being tested in simulators. But if it's approved and airlines like Southwest can resume MAX flights this year, then Boeing will keep building 42 MAXs a month and plan to ramp up production next year.
If they are able to relaunch this plane, and it's, as they say, the safest plane to ever fly once they bring it back into service, then their reputation can be preserved. They are battling for their very existence, for their very reputation right now.
Meanwhile, Treasury Secretary Steven Mnuchin weighed in on the MAX controversy and what the president thinks of the beleaguered plane.
I think, as you know, the president has said he's concerned about the 737 MAX. Quite frankly, he thinks they should bring back the 757 and look at selling 757s.
Boeing is not bringing back the 757. In fact, it stopped building that plane in 2004, and reviving it would cost billions of dollars. Instead, the focus right now is on getting the MAX back in the air by the end of the year. Phil LeBeau, Nightly Business Report, Chicago.
You just saw Jim Corridor in Phil's story there. He's industrials analyst at CFRA Research, joining us now to talk about what he believes to be are the best and worst case scenarios for Boeing. Jim, good to see you again. Welcome back.
Thanks, Bill.
Let's start with the best case scenario. What do you think it is?
Well, best case scenario is they are very close to having the software ready to go. They bring it to the FAA sometime in early September. The FAA, who was at Boeing's side through this whole process, who was in the simulators with Boeing, approves these planes, and they get back to flying early October. Then Boeing can start delivering all these planes that are parked at their facilities all over the country and start booking these revenues and getting this thing moving again.
All right. Worst case scenario, how bad could it be?
Look, yeah, the worst case scenario is the FAA finds some kind of problem with the software fix, pushes back against Boeing, says we're not ready to bring these planes back out again, and Boeing has to halt the production line, has to furlough some workers. Their suppliers will not be able to continue to produce at the rate they're producing, causes a whole global supply chain effect, and affects more than just Boeing, but a lot of companies.
All right, let's talk reality now. What do you think is most likely to happen, and what's the impact going to be on the company?
Yeah, I think Boeing was very careful not to announce a timeline for the return of the plane until they felt it was ready. Last week they said they felt it was going to be Q4. Today they said they felt it was going to be early Q4. So I think that they're fairly confident that they have the right fix in place. They've been testing it now for quite some time. And I think it's the most likely scenario is that before the end of 2019, that plane is flying in the air again.
Even though some regulators here and abroad have said quietly that they don't think it flies until next year sometime.
Yeah, I think that once the FAA gets on board, Boeing is going to have a coordinated effort with European regulators, with Brazilian, with all over the world. Once the plane is deemed to be safe, I think that there will be a push out to get everyone on board, and I think that they will be able to do so.
All right. Jim Corridor with CFRA Research. Again, thanks for joining us tonight, Jim.
Thank you, Bill.
Elsewhere, Caterpillar is having a tough time navigating the slow economy right now globally. The maker of big machinery missed Wall Street earnings estimates and said that profit for the year would be at the lower end of its previous guidance. Cat shares fell about 4.5% today, making it the worst performing stock in the Dow. Seema Modi has more on Caterpillar's quarter.
Caterpillar is finding it tough to do business. A slowdown in the U.S. shale boom and higher manufacturing costs cut into profits. Revenue from its oil and gas division fell double digits, due in part to weakness in the Permian Basin as some customers pull back on making large capital investments. Volatile commodity prices didn't help either. Over in Asia, growth remains a challenge. Perhaps most concerning, weakness in China, which was once a key market for the industrial heavyweight.
Cat's had many, many years of gaining share and doing very well in China, selling bigger products, more durable products, just, good stuff, and then several months of losing share again. So whether that's related to geopolitical tensions or just pricing, it's not yet clear.
Tariffs are pressuring margins, and winning new business in China is not easy as it used to be.
We expect continued pressure from competitive pricing in China, partly offset by growth in other areas of Asia Pacific.
Caterpillar did reference strength in construction, which makes up a bulk of its sales. It's also more positive on North America, though still sees weakness in the housing market. But one thing is clear: if the global economy worsens, the industrial sector is headed for more pain. For Nightly Business Report, Seema Modi.
And as we mentioned at the top of the broadcast, the S&P and the NASDAQ reached all-time highs today. Chip stocks rallied and investors essentially brushed off regulatory concerns facing big tech right now, and we'll have more on that in a moment. But first, the final numbers today, with the industrial average down 79 points. We're at 27,269. NASDAQ was up 70. The S&P added 14. So far, the greatest regulatory pressure from Washington has been on Facebook, but you would never know it by looking at its quarterly results today. The social media company reported better than expected earnings, and revenue was up sharply. But the stock was volatile in after-hours trading tonight. Julia Borston has details of Facebook's results.
Facebook continues to grow revenue faster than expected, even as big regulatory issues weigh on the company. Facebook's generating more revenue per user than predicted. This as the company takes an additional $2 billion charge as a result of the FTC fine for privacy violations, coming in at the highest end of the range Facebook gave last quarter. The company notes that the online tech industry and Facebook have received increased regulatory scrutiny in the past quarter, announcing that in June, Facebook was informed that the FTC opened an antitrust investigation into the company. This in addition to the Department of Justice's announcement yesterday that it will begin an antitrust review of market-leading online platforms. Mark Zuckerberg saying, "We are investing in building stronger privacy protections for everyone and on delivering new experiences for the people who use our services." For Nightly Business Report, I'm Julia Borston in Los Angeles.
That FTC investigation that Julia just mentioned was officially settled today. The commission fined Facebook $5 billion for its mishandling of user data after it was learned that political consultant Cambridge Analytica had secretly gained access to 87 million Facebook accounts. The settlement orders Facebook to create new layers of oversight, and CEO Mark Zuckerberg will be held personally responsible for making sure that that happens.
I think Mark Zuckerberg is held personally accountable. He's signing the order. He's named specifically in the order. The order requires him personally to certify that that the company is in compliance with our order quarterly. And if he files false certifications, then he's subjecting himself to civil and criminal penalties.
Now, the FTC is not Facebook's only headache. As we have been reporting, the Justice Department has started an antitrust review of some of Silicon Valley's biggest tech giants to determine if they have purposely been stifling competition. The companies being reviewed have not been named in the announcement, but most believe them to be Facebook, Amazon, Google, and Apple. And tonight we take a look at what the DOJ may be targeting at each company. Back with us is Julia Borston on Facebook.
Facebook is the second largest digital ad platform with 29% of U.S. digital ad spending between Facebook and Instagram. And Facebook is the most dominant social platform when it comes to users' time. Americans spend nearly 40 minutes daily on Facebook, plus almost a half hour on Instagram, dwarfing the time spent on Snapchat. And as the DOJ looks at how Facebook has leveraged the power of its large network, it has become a force in other areas, including mobile communication and news. Facebook's Messenger and WhatsApp together have nearly 3 billion monthly active users. By comparison, Apple has 900 million active iPhones. And over half of American adults say they get news on Facebook or Instagram. The question is whether Facebook is unfairly leveraging its social media power to dominate in new areas, ranging from online dating to movie ticket sales to digital currency. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Now to Deirdre Bosa with a look at the issues surrounding Amazon.
3 reasons Amazon could get caught in the regulatory crosshairs. First, it controls nearly 40% of all U.S. online retail sales. eBay is a distant second with just 6% of the market. Second, potential competition with third-party merchants on its own platform. CEO Jeff Bezos said earlier this year that third-party sales, that is small and medium businesses who use Amazon's platform, made up more than half of total sales. Critics argue that Amazon could use data from these sellers to unfairly compete against them and push its own private label products, from diapers to electronics to toilet paper. Third, regulators could zero in on the Amazon Prime flywheel. If Amazon is using money from other business units to subsidize video or music services, how can other companies that do have to make a profit compete? Deirdre Bosa, Nightly Business Report.
And finally, as we mentioned, Google parent Alphabet and Apple may also be under scrutiny. Here's Josh Lipton.
Google could be in the government's crosshairs, in part because of its estimated 80% market share in search. Antitrust officials will have to decide if that's a monopoly harming consumers. But Google officials recently testified on Capitol Hill disputing that argument.
For example, when consumers search for information, they can choose among Amazon, Yelp, Microsoft, Travelocity, and many other companies like these that consistently report strong user growth. If you don't want to use Google, there are many other information providers available.
And then there is Apple.
I don't think anybody reasonable is going to come to the conclusion that Apple's a monopoly. Our share is much more modest. We don't have a dominant position in any market.
But what about the company's App Store? Critics of Apple and Google's app stores argue that the companies favor their own apps, and as a result, a whopping 70% of all in-app spending goes to the tech giants. Apple also controls access to the App Store. But some analysts think an antitrust case could be tough to make because it's not clear to them how the App Store actually harms consumers, given the breadth and depth of competition on the store itself, they say, and within certain categories like gaming, where some apps are free and some aren't. For Nightly Business Report, I'm Josh Lipton, San Francisco.
So how concerned should shareholders be about this Justice Department review? Joining us tonight is Mark Lebanese, president at JMP Securities. Good to see you again, Mark. Thanks for joining us.
Thanks, Bill.
I guess the short answer from you is they shouldn't have to worry much. Why?
Well, I mean, you're going to be worried because there's going to be a lot of headlines coming up, and I think that's something that we will continue to pay attention to. But like we saw with the Cambridge Analytica scare of the last year, and Facebook at its all-time high a year ago, about now when they reported second quarter earnings, there were a lot of headlines and a lot of legislative meetings, but really nothing's happened except some self-regulation and, frankly, a slap on the wrist on this $5 billion fine.
Right.
I think the self-regulation is more likely, and I think you're going to see lots of headlines and lots of bluster, but very little coming out of Congress,
well, let's go
and let alone the legislators.
Let's look at each company and see where the vulnerabilities may lie. Facebook, I mean, they clearly have been under the most intense scrutiny as it pertains to their user data and the data breaches and all that. I mean, but at the same time, we just learned today that the users haven't fled at all.
Well, Facebook always reminds me of, Hall & Oates, who sold a couple 100 million albums, and they always said nobody admitted to buying one. Nobody admits to being on Facebook all day, yet the data says that people are on 40 minutes a day on that, and as my kids are an example, on Instagram as well. People are not going to flee that platform. It's where they get their news. It's where they get their social engagement, and that's a really hard thing to legislate, and I think that's why it's not going to change going forward.
Amazon, as we heard, they may be most vulnerable when it comes to their third-party sales and so forth, and the strong-arming that they do there and the data that they're able to accumulate.
Amazon certainly has an issue there. I think they're going to continue to gain the market share that they have on the retail side, but it's very hard to legislate where people go. And I think you're going to continue to see consumers want that, maybe some additional choice, and maybe there'll be some small slap on the wrist that they will probably self-legislate. But I just don't see Congress being able to legislate where people's eyeballs go and where they want to buy things. It's been historically a very hard thing for Congress and the Justice Department to legislate.
Google may also be most vulnerable as it pertains to search results and the juggernaut that they are in that area there.
Google obviously has an overwhelming share. In fact, it's become a verb, right? We're going to Google that search. So I think that is another area that will have great headlines, and they could probably rank choice some of the data that does come up, but that may favor some of Google's top advertisers or other consumers. But they really have to pay attention to Google because they have the juggernaut for market share. So I think, again, all these stocks are going to be in the headlines for I think, some time on these data, but I just don't see Congress being able to legislate where people's eyeballs and clicks decide to go.
Very quickly on Apple. I mean, Tim Cook has said they're not a monopoly, but what about the App Store and the tremendous iron fist that they wield there?
I think it's somewhat similar. You have a consumer who goes to that app store constantly and is looking for new ways to access companies and data and products, et cetera. There will probably be some self-regulation where they decide to put certain things on top of others or certain things at different points on the app store. But like you said, that's an open marketplace. And the Congress and the legislators and people who regulate like marketplaces, they will probably find some way to self-regulate. Yeah. I just think that app store is here to stay.
And for the record, I was a big fan of Hall & Oates myself as well. Mark Lehman.
You and me both, Bill.
Mark Lehman with GMP Securities. Thanks again for joining us tonight.
Thank you.
And still ahead, does the most recent budget deal show that the deficits don't matter anymore? In the news today, Queen Elizabeth officially appointed Boris Johnson the Prime Minister of the United Kingdom. Johnson immediately began forming a government, one that he vows will lead the UK out of the European Union.
The people who bet against Britain are going to lose their shirts because we're going to restore trust in our democracy. And we're going to fulfill the repeated promises of Parliament to the people and come out of the EU on October the 31st. No ifs or buts.
Now to the U.S. economy and that recently agreed to budget deal. As we told you, it raises spending by hundreds of billions of dollars over the next 2 years. Now, there was a time when Wall Street and Washington worried quite a bit about debt and deficits. Do they still matter? Steve Leisman went in search of some answers.
The $22 trillion size of the U.S. debt is astronomical, no matter how you measure it. In fact, it's equivalent to the estimate of the total number of stars in not one, not two, but 22 Andromeda galaxies. That's the closest neighbor to the Milky Way. And the debt is growing. It doubles roughly every 10 years and is now set to rise by roughly $1 trillion a year if the recent budget deal is enacted into law. So it seems strange to ask, do the trillions upon trillions really matter? Surprisingly, the new trend among politicians on both sides of the aisle in Washington is the debt doesn't matter, and neither investors nor economists entirely disagree, at least for now. First, while the debt has doubled, the government's cost of borrowing has fallen from 6% in 2000 to around 2% today for a 10-year bond. So larger debt has not pushed up interest rates. Second, the size of the debt does not appear to have dragged much on growth. Annual government deficits decline in times of strong growth and they rise during recessions. This is in part by design as the government spends more to kickstart a weak economy. One of the most influential recent developments was a paper presented last year by former IMF chief economist Olivier Blanchard. He argued that as long as a country's interest cost is below its nominal growth rate, countries can or even should borrow more. In the U.S., it's like the government invests at 2%, that's the cost of a 10-year, and gets returns of 4%. That's about where nominal growth is for the U.S. Net return, assuming the money is invested well, 2%. So is all that old thinking wrong that deficits actually matter? Might sound like it today, but perhaps not forever.
This may be less of a problem now when we're in very good economic times, but it is sort of loading the shotgun aimed back at our economy if in the future interest rates have to go back up, and then this tremendous debt service will dramatically limit the ability or force us to borrow even more at a very costly rate.
Higher rates could raise the cost of servicing the debt and crowd out spending on things like education and defense. The U.S. has trillions of dollars of unfunded liabilities in health and Social Security costs it will soon be paying. High debt levels also could limit the ability of government to spend more to help the economy in the next recession. In Washington, the prevailing political opinion is to ignore all of that in favor of bigger spending and lower taxes today. If rates remain low and the economy continues to grow, it's all hard to argue against. And that may be the best argument for at least some fiscal prudence today. No one knows quite how long all the stars will align as perfectly as they are today. For Nightly Business Report, I'm Steve Leisman.
UPS delivers for investors, and that's where we begin tonight's market focus, with the company posting better than expected earnings and revenue, and it raised its guidance as well. UPS also said that it expects to get FAA approval for drone delivery by the end of the year. And to compete with rival FedEx, UPS will also be offering a 7-day delivery service next year.
As a company, we had to realize that Sunday, Saturday, and Sunday, just like another day of the week. We chose some excellent partners in Michael's, CVS, and Advanced Auto Parts, and also for Sunday delivery, enhancing SurePost with USPS. So with those combinations and with our network, we feel that we have another good offering for our customers.
Stock rose more than 8% today to $114.39. Health insurer Anthem's results topped expectations, and the company also raised its full-year guidance. But Anthem said that costs connected to its Medicaid business were higher than expected, and shares fell more than 4.5% today to $288.91. VF Corp beat estimates thanks to sales increases of its Vans sneakers and its North Face clothing lines. The apparel maker also raised its full-year guidance. Stock was up more than 1% to $89.33 today. AT&T beat revenue estimates, and earnings were in line in growth in its wireless and media sector. They helped offset continued declines in DirecTV subscriptions. AT&T shares rose more than 3.5% to $33.24. And then after the bell, strong sales of Ford's F-150 trucks and other SUVs were not enough to offset the automaker's costs to restructure its global business. As a result, Ford missed earnings expectations and issued soft guidance. Shares initially dropped sharply after hours tonight, but they did close the regular session up more than 1.5% to $10.33. And coming up, turning sour, why the trade war with China is the pits for one American farmer. Treasury Secretary Steve Mnuchin today did confirm that he and other trade negotiators will be meeting with their Chinese counterparts next week in Shanghai. That's certainly welcome news to American farmers who have been hurt by tariffs. But one farmer is not sitting around waiting for them to end. He took it upon himself to head to China to try and drum up demand for American cherries. Eunice Yoon went to Shanghai to speak with him.
This box right here is an ideal quality for the Chinese consumer.
Despite the trade war, Seattle native Keith Hu is making his best pitch for American cherries.
China is still very important to the farmers, the Northwest cherry growers.
This is the second largest wholesale fruit market in China. And every year, Keith Hu comes to Shanghai to talk to importers to get a sense of what the appetite is in China for U.S. cherries.
China is a critical market for the cherry growers, making up more than a third of total exports. So they feared the worst when Beijing raised retaliatory tariffs to 50% last year on their cherries, forcing prices for consumers up on average 60%. Overall volumes plunged by 40% from before the trade war. But the farmers are still making money.
Hey, George.
So far, Chinese importers like George Liu have been willing to eat the extra cost.
So because of the tariff, the U.S. cherry right now in the market needs to be selling at a higher price. So in the end, it will reduce the demand a little bit. But Chinese people, they're willing to pay for premium product.
To keep people here buying, Hu is tapping into the Chinese desire to live a healthier lifestyle.
We try to push the health message of cherries and also the lifestyle of the USA Northwest. We try to sell them the idea of living in a pristine environment with fresh air, fresh water.
But he's still losing sleep over what might happen if the trade war continues. There's new competition from cheaper cherries from Turkey and Uzbekistan.
Besides cherries, a lot of berries, other fruits coming from other countries. These are our competitions. I mean, we are fighting an uphill battle. So with a tariff, it just made our challenge even bigger.
For Nightly Business Report, I'm Eunice Yoon in Shanghai.
And that is Nightly Business Report for tonight. I'm Bill Griffith. Thanks so much for watching. Have a great evening. We'll see you tomorrow.